from chapter 1 to chapter 13, we learned a lot of concepts, and one of the key thing that you should be able to do is to evaluate an investment project or evaluate the value of the company. And this will be only possible if you know the cost of capital, because you need to have a discount factor. And the chapter 14 is about the discount, how to determine the discount factor. And in the last class on Monday, I talked about the cost of capital in general, and then I said that we can classify them into several categories, including the cost of equity, cost of debt, and cost of preferred stock. And it depends on, for a firm, whether how they get, where they get their money determines the overall cost of capital, and that will be our last topic in today's class. And the most difficult part is to determine the cost of equity, because the cost of equity is usually hidden. So you may need to find it out by yourselves, and you can utilize as an undergraduate student, you can rely on two models: dividend growth model that I discussed on Monday, and the capital asset pricing model in chapter 13. So let me talk about the capital asset pricing model. So the capital asset pricing model shows you that the rate of return from a stock can be determined following this formula. So you have RF, risk-free rate of return, and RM minus RF here. Here the RM states the return from the overall stock market. And we usually say that this term, RM minus R beta, symbolizes the market risk premium. And finally, you need to know the beta, which is about the information at which level the company is taking the risk. So if the company is riskier, then the beta becomes higher and higher. If the company is safer, then the beta becomes zero. Big beta becomes close to zero over and over. So, for example, let's say Walt Disney has a beta of 1.11, and the market risk premium is given as 7%. And the US Treasury bills, the rate of return from the US Treasury bills is 1.53%. And then you can easily calculate the Walt Disney's cost of equity following the CAPM. And one thing that you should keep in mind is that in reality, we often use the US Treasury, the government bonds, as a representative item for the risk-free asset. So here 1.53%, this will be the risk-free rate of return, RF. And then the rest is very simple. You can just use the formula. So the cost of equity is the risk-free rate of return, 0.0153, because this is 1.53%, and beta, which is 1.11, and the market risk premium 0.07. However, you need to be sure, you need to check before your calculation, because sometimes the problem will give you the market risk premium itself, but on the other hand, the question will give you the information about the market return. So if the market return is given, then you need to calculate the market risk premium by subtracting the risk-free rate of return. But if the market risk premium itself is given, then you can just use this number into the formula. But in this case, we have already the market risk premium, so we can just use 0.07, and the cost of equity is 0.093, which is in percentage scale 9.3%. So if you know the formula, then the rest is very simple. The capital asset pricing model is applicable to almost 99% of the companies in the world. However, there are also certain cases that you cannot directly use the capital asset pricing model. The capital asset pricing model assumes that the stock is traded in an exchange. So the stock is already listed in a stock exchange such as KOSPI, KOSDAQ, New York Stock Exchange, or NASDAQ. However, if the company never had listed their stock on the exchange, in other words, they can be venture firms, they can be startups, they can be very, very small company, then investors cannot trade their shares, so you cannot use the capital asset pricing model. So that's the only caveat that the CAPM has. However, for other cases, for almost all cases, you can just use the CAPM as the beginning of your analysis. And next, we have cost of debt. So, as a company, you often have two primary choices. You can raise capital from stockholders or shareholders. On the other hand, you can raise capital or you can finance your projects through borrowings. For example, you can visit a bank and you can borrow from there, or you can issue some bonds. And these borrowings will determine the cost of debt. There is no one that he or she will give their money without any charge. So whenever you borrow, you need to promise something back. We call it interest, right? So if you borrow some money from the bank, you not only pay the principal at the end, but at the same time, you are required to give certain interest to the bank. So that's how the banks become profitable. And the same logic applies to it. So you have certain cost of debt from the perspective of the corporate manager, because you are borrowing and you are making some commitments. And then, how can you determine the cost of debt? That is relatively easier than the cost of equity, because in many cases, the cost of debt is already written. It is explicit. It is already determined. It is shown. So you don't have any other additional analysis anymore. So this is very easy. However, you need to at least understand what do we call the cost of debt. So let me explain about the yield to maturity. Okay. So this is a typical timeline of trading a bond in the bond market. So as an investor, you begin here. So this is present today. And let's say that the bond will mature after 3 years. So let's think about this. So what does it mean by issuing a bond? Issuing a bond means making a contract. It is making a promise. So there are two parties. There is a corporation, the company. The company is borrowing. But at the same time, there are some investors. They are giving money. They are lending money. So they want some returns at the end. And we call the principal, in the case of the bond, the face value. So this is the total money that the company borrowed. Or in other words, the total money the investors lended at the beginning of this contract. And then the major characteristics of the bond is that there are two different cash flows. First, at the end, the company needs to pay the money back, the principal. So at the end, let's say the face value was $100, and when the bond matures, so this is the end of the period. So this is the time where the company promised to give the money back, and they need to give the face value back, which is $100. So this is the first imaginable cash flow. But at the same time, the bond has different cash flows also, which are called coupons. So coupons are interest given back to the investors from time to time. So maybe they can pay it annually. So for every year, they are going to give some money to their investors. Or maybe they can decide to have 6 months as their period for they can pay at the beginning of January, and then they pay again at the beginning of July, and they pay again at another January. So it goes on. So let's say the coupon is for $5 in this case. Then actually, when the bond matures after the 3 years, what the investor gets is $105, adding the face value, the principal, and the coupon, the interest. So now today is here. So this bond is already existing. And the major difference between borrowing from a bank and issuing the bond is that in the case of bank borrowing, the company always needs to go back to the bank. So it does not change the fact that the bank is the lender. But on the other hand, the bond is different. Bond is tradable. In other words, the initial investors can, at some point of time, they can decide to get out of this project. They can decide to get out this investment, and they want to make it into cash. How can they do it? They can just sell the bond to other investors. So they are traded in the bond market, which means there are sellers and there are buyers of the same bond. And these sellers and the buyers are all investors. So there are two groups of investors. And as a new investor, you don't have to worry, because if you are interested in bond market, then whenever you became interested in, then you can just go to the bond market and purchase one there. So you can participate even though you are not the initial investor. So that's the benefit of the bond, because it facilitates the investors' participations. You don't have to be initial investors. You can join later. And at the same time, even if you are an initial investor, you can just come out whenever you want. You can exit and you can make it into cash by just giving it to another person. So anyway, come back here, and today is here. And as an investor, you decided to buy this bond, and let's say that you bought this bond at $98. So let's think about this price. So in the market, whenever we say there exists a market, it means there are a lot of sellers and there are a lot of buyers. But if you are a seller, you don't want to sell your product at a cheap price. You just want to get enough money. So they may suggest that the bond price should be $102. They can suggest that the bond price should be $105. And some can even argue that the bond price should be $150. It is possible. This is their choices. On the other hand, we have a lot of many buyers. And buyers want to save their cost. Buyers want to propose a lower fees. So they suggest, say for example, they can suggest $95 as the price. They can suggest $90. However, it is not above $100, right? So there are two different opinions. But eventually, the fact that you bought a bond at $98 means there was an agreement. A seller, at least, agreed to that price, and the buyer agreed to that price together. So that's why they made an agreement. So in this transaction process, in these biddings, infinite number of biddings, what we get is the market price, and the price represents the all information in the bond market, as well as how investors feel about the value of the corporation. So this is the result of all human brains combined. So that's why we believe that the price determined in the market is superior other than any other prices. So that's why we believe in the market price. That's why we believe in the market value over the book value. So anyway, we got $98 as the price. Then what is your rationale? Your rationale is this. Okay, I bought this bond at $98 today. And this should be also related to the benefits that you can have from now on. You don't have to care about the past. As a rational person, you forget everything that is already determined in the past. So you don't have to care about what was the face value at the beginning or what was the price in the bond market last year or 2 years ago. You only care about what will happen in the future. So that's the economic way of thinking. So anyway, you have 3 cash flows that will be generated from this bond. In the first year, you get $5. In the second year, you get $5. And lastly, in the third year, you get $105 from the bond. So therefore, based on the net present value method, or in other words, based on the discounted cash flow valuation method, you have this calculation. I have $5 in the first year. I have another $5 in the second year, and I have $105 in the third year. And whatever my required rate of return is, that will affect my pricing, which is $98. So here you can reverse this calculation and you can find out what should be R in this case. And that is known as the yield to maturity, because it is the yield, in other words, the rate of return that you can get from today to the end of the time, so the maturity. So that's why we call it YTM, or yield to maturity. So this is a general formula to get the yield to maturity. However, I like to emphasize that at this moment, you don't have to care about this formula, because for your convenience, your exchanges, your security firms, your brokers will calculate this instead of you and provide the number. So you don't have to care about it. But we can just understand this. It seems complicated, however, it is very simple. So you have coupons after 1 year, in the second year, and in the third year. And coupons are the same for every year. So it is annuity. So that's why we use the annuity formula into the calculation. And finally, at the end, you get back the face value, which is $100 in this example. So you need to discount it by dividing it with respect to 1 plus R to the power of maturity. So this is just another representation of this calculation. So it is not that complicated. Okay. So what we need to do as a corporate manager, if we want to know about the cost of debt, what we need to do is just to look at the yield to maturity of our company's bond, and that will be the answer. However, sometimes there is a limitation. Some companies already have the bonds existing. In that case, you can find out the yield to maturity and use it as the cost of debt. However, the other companies may not have existing bonds. Then it is very tricky because you don't have the yield to maturity information. In that case, you can alternatively use another firm's cost of debt. For example, let's say you are a manager in SK Hynix, which is a semiconductor producer in Korea. And let's say, this is unrealistic, however, let's say there is no bond for SK Hynix. Then you can look at Samsung Electronics bonds, because Samsung Electronics is also a semiconductor manufacturer, and also they are both large corporations with similar characteristics. So you can have alternative information from other companies. Before we move on, there is one thing that you also need to care, which is the interest tax shield. So to understand what is it, you need to have a structure of income statements in your mind. Income statement. So this is one of the representative financial statements that you are going to rely on if you want to get information about a company. And generally, it starts with sales, or in other words, revenues, the money that the company make, and there are cost of goods sold, and there are depreciation. So you take out these two, and what you get is earnings before interest and taxes, and in short, EBIT. And then from the EBIT, you take out interest, expenses, and you take out taxes, and finally you get net income. So this is the typical structure of the income statement. And in this kind of calculation, you should pay attention to the fact that before the calculation of taxes, you always subtract interest expenses first. So it makes a huge difference. So let me give you an example here. So there are two similar companies. Firm U, this is a unlevered, so it has no debt. But on the other hand, there is a firm L, which is levered, and it has bonds existing. And the rest of the characteristics are the same, so they have the same profit. So their earnings before interest and taxes are the same as $1,000. Then let's draw their income statements. So they have EBIT the same. However, firm U has no debt, therefore their interest is 0. But on the other hand, firm L has bonds, which means they have to pay the coupons, so they have 80 interest expenses. So their taxable income changes. Firm U's taxable income is still $1,000. However, firm L's taxable income is reduced to $920. And based on the same tax rate, which is 21%, the firm U will pay $210 as taxes, but firm L will pay $193 to the government. So if you just concentrate on the taxes, which one is better? Firm L is better in terms of paying taxes less, because they can save some of the money because they consider their interest expenses in their taxable accounting. So this is a benefit, which is a kind of side effect. This is not intention. This was not an intention. However, for somehow they were able to save some of the cost. So this is the benefit, side effect of having debt in their company. So therefore, we should also consider this fact into consideration. So what we are carrying is the coastal debt. We are thinking about this coastal debt, which is a negative aspect. Because you borrow, you promised that you will give some interest and the principal to the bondholders, so you have some obligations, and this is your burden as a corporate manager. However, thanks to the accounting, now you have some benefits, which is tax savings. from the interest. So therefore, in your calculation, if you want to talk about the effect of having debt, you should consider not only this overall cost of debt, but also you should consider this benefit. So therefore, what you need to calculate is this one, except tax savings, right? So that will be our concern for the final calculation. So whenever you calculate the cost of debt, we differentiate between two terms. We have pre-tax cost of debt, and we have post-tax cost of debt. And what we are going to use is actually the second one, not the first one, because it does not consider the benefits coming from the tax savings. So we should use it as our real finalized cost of debt in our calculation. And that will come back to us in the last topic. And let's talk about the cost of preferred stock. Preferred stock are stock, so they are also classified as equity. However, there is a difference between common stock and the preferred stock. Common stock, there is no guarantee that the company will give you the dividends. So that's the reason why the cost of equity is difficult to get. You don't know what will be your return. However, in the case of preferred stock, when they make preferred stock, they specify the dividends for the preferred stock. So therefore, the cost of preferred stock is also easy to obtain because they have a specified dividend level. You can easily calculate their rate of return. So now we have talked about three different costs. We talked about cost of equity, we talked about cost of debt, and we also talked about the cost of preferred stock. And we want to combine them into one simple measure to be used as the discount factor, and that will be called as weighted average cost of capital. So let's think about an imaginary company, XYZ, and this company has debt of 100, equity 200, and among the equity, 100 is from common stock and the other 50 is from preferred stock. And the corporate tax rate is 30%, and let's assume that you already calculated each cost. So the cost of common stock, in other words, the cost of shares or the cost of equity is 20%, and the cost of preferred stock is 12%, and the cost of debt is 10%. In other words, common stock shareholders demand this company to have at least 20% of return for their contribution. Preferred stockholders demand 12% return for their contribution. Creditors, the debt holders, demand 10% return at least for their contribution. And then, as a company manager, you need to satisfy these contributors. You need to satisfy both the shareholders and the creditors. And the common stock shareholders desire $30 because they contributed $150 and they want to have 20% return. Preferred stockholders expect that they can get $6 because they contributed $50 and they demand 12% return. Bondholders or the creditors expect $10 because they contributed $100 of debt and they require 10% rate of return at least. So in aggregate, the company needs to have at least 30 plus 6 plus 10, which is 46. However, you should come back to this issue. There is a savings. There is a benefit from the debt, which is the tax shield, which is 100 the debt, 10% the interest times the tax rate, and the tax benefit is $3. So considering this, you can have minus $3 for your minimum return, and you have the minimum return at $43. In that case, your overall required rate of return is, because you have 100 plus 150 plus 50, which is 300. This is your asset, and from out of $300 asset, you earn $43. So your rate of return is $14 something. And this is the result. So you need to use it as the discount factor. However, to generalize, let's think about these 43 instead of doing calculation by step. So we are just going to insert these formulas into here. And what we get is this long formula. So it requires a lot of calculation. However, first, what you did is the calculation about shareholders. Shareholders contributed 150 and they require 20% return. The preferred stockholders contributed $50 and they require 12% return. The creditors, the bondholders, contributed $100 and they require 10% return. However, there are tax savings. $100 debt, 10% interest rate, and 30% tax rate. So these are the tax shield effect. And adding these four, and you divide this all with 300, which is the size of total assets. So now it can be rewritten like this by combining the last two terms. Because they are related to the debt, you have this formula. First, you have shareholders' value times 20% return, preferred stockholders' value times their rate of return, bondholders' value times their rate of return times 1 minus 30%, because this is about tax savings. And if you generalize it, you can have this formula as a result. Equity value times rate of return by shareholders, preferred stock value times the rate of return by preferred stockholders, the value of debt, the cost of debt times 1 minus taxable, the tax ratio divided by the size of the company. So this is called as the weighted average cost of capital. And maybe one may wonder, why is it called the weighted average? So let's think about the concept of averaging some numbers. So let's say we have a simple average. So let's say I want to calculate the average of these two numbers. You are younger than me, so your brains are much more faster than me, so you will easily get their average is 0.15. However, if we analyze the steps to get this number, what we have is this. So this is 0.1 plus 0.2 divided by 2 because we have two items, and we get 0.15 as the average of these two numbers. And it can be also rewritten like this, because here we have a dividing number and it can be applied same to all items here. And it can be also rewritten like this, because 1 over 2 is 0.5. And here 0.5 means 50% and another 50%. So the meaning of the average, the simple average, is that you treat these two items samely important. You have 50% importance and you have 50% of importance on these two numbers respectively. So that's why you have a balance and then you get a 0.15. However, sometimes we want to have different idea, and that is known as the weighted average. In some case, you again have the same number, but you want to calculate the average. However, you put more attention to a specific number. So let's say you have 80% importance for this number and you have 20% importance to the second number. And then using the logic here, we can calculate this number by and this will be 0.05 plus 4, so it will be 0.12. So this is the result of your calculation, and you can see that 0.12 is different from the previous result, 0.15. So what we have is that in the previous calculation, you have the same weight, so you exactly get the median point, which is 0.15. However, in the latter calculation, because you emphasize the first number more, you get a number which is closer to 0.1. So that's the result of the weighted average. And actually, what we have in this calculation is the same. In a nutshell, what we want to have is the combination. In other words, the average of RE, RP, and RD. We want to have an average, the mixture of the required rate of return by the equity holders, the required rate of return by the preferred stockholders, and the required rate of return by the bondholders. But we put different significance, we put different importance to these numbers because the company may rely much more on equity, or in other cases, the company may rely much more on the debt. So therefore, what we want to have is the weight, which is how much money we rely on to that specific investors. So if we rely on much more on the shareholders contrary to the bondholders, then we put a higher number here. But on the other hand, if we rely on the bond financing, debt financing much more, then we have a higher number here and we have a lower number here. So by having different weights, we can make a mixture. We can calculate the combination differently. So that's the meaning of the weighted average cost of capital. So there is an example here. So there are a lot of information given at the simultaneously. However, if you look at them line by line, it is very simple. So what you want to have is the weighted average cost of capital. And as I said, the most difficult part is to get the cost of equity. So we are going to rely on these two models. First, we can get the cost of equity based on the CAPM. So we have beta, the risk-free rate of return, and the market risk premium. And we get approximately 10%. And we also can rely on the dividend growth model because the company also has dividend, and then we get different number, which is 7.6. Then what will be our measure of the cost of equity? There is no answer because both of the models are theoretical ones. So there is no guarantee that one is correct and the other is incorrect. It can be correct and it can be correct. We don't know. So in this example, we just decide to use these two together. So we are going to use the average of these two results as the estimation of our cost of equity. Then the cost of debt is simple. Why? They already taught us. They gave that information. Yield to maturity is 2.98. So we don't need any extra efforts. We can just use it as the cost of debt. And then you need to have the weighted average. But remember, when we calculate the weighted average, we need to have the value of equity and the value of debt. And there are two different concepts regarding the value. It could be book value, which is written by accountants in their financial statements, but also we can rely on the market information. And we generally say that the market value is superior to the book value. It is more important to rely on the market value. So in this example, we first calculate the value of equity. The market value can be calculated based on the stock price. So we get this number and we can get the weight for each one. So the weight of equity is, this is the weight of value of equity and this is the value of debt. So the adding them will give you the value of the company in overall, and the value of the company, the value of equity divided by the value of company is 71%. That means the weight for the debt should be 29% because if you add them, in this example, there is no preferred stock. So if you add these two, you should have 100%. So as you can see, this company rely more on equity financing rather than debt financing. So therefore, we are going to emphasize the cost of equity more. And therefore, our last calculation should be this one. 71% of equity, and the cost of equity we are going to use is 8.9 something, and 29% of that, and the yield to maturity was 2.98, and we have a tax shield effect. So therefore, we have a 1 minus 21%, which comes from the fact that the tax ratio is 21%. And finally, we get 0.0704, which is 7.04% as the weighted average cost of capital. And whenever Eastman, this company, evaluate their projects, or whenever the company wants to know about their value, they should use this number as the discount factor in their calculation of the net present value. So that completes our long journey from chapter 1 to chapter 14. So from chapter 1 to chapter 13, we learned about net present value approach, the discounted cash flow valuation, blah, blah, blah. And finally, we know how to get the proper discount factor. So from now on, using these methods that we learned in the course, we can apply the net present value approach to any company's projects.